Greetings viewers. I, Dr. Isha Raval, Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi, welcome you to the series on security analysis and investment management. In today's session, we will be learning about what is capital asset pricing model. How do we price the capital assets? And we will also understand what is security market line, how do we measure return and risk, and how do we compare and identify that basis the return and the risk, what ideally should be the expected return when we are investing in any of these assets. So let's get started. What exactly is capital asset pricing model, which is a very famous model and is also known as CAPM or CAPM. So this is one model, one basic theory that links return and the risk for all the assets. So this is one theory which is providing the basic link between the return and the return and the risk for the assets. This CAPM quantifies the relationship between risk at one hand and return on the other. That means it measures how much additional risk an investor should expect from taking a little extra risk. That means suppose you are an investor and you have the option to put your funds in a fixed deposit, maybe in post office or in a bank FD. So technically you will say that I do not have any risk because I'm very sure that if I put my funds in a bank account or in an FD, this is certainly going to come back to me. But the rate of return which you get on the FD is say 6%. Now, your friend suggests that instead of getting this 6%, why don't you invest your funds in, say, company A, or why don't you invest your funds in the stock market? Now, you as an investor will analyze the situation, will try to compare how much is the risk and what is the return which I am getting. You will question your friend that what is the return which I can get from it? Because now, after shifting from the FD to the stock market, there is an substantial increase, I would say, in the risk associated with investments. Because we all understand that when we put funds in the stock market, we are not sure that what is going to be the return, or whether even our initial capital will be coming back to us or not. So you as an investor would expect a certain higher return because you are bearing the extra little risk by investing in the stock market. So how much should be the return which you are expecting? This sort of calculation is done with the help of the capital asset pricing model. So this asset is actually providing the link between what is the quantum of risk and how much is the return in comparison to the risk which you are bearing. So if the risk goes up, is the return also moving up? And if this return is also going up, is the return justifying the existing quantum of risk in the investment? So if as an investor, as a rational investor, you would always prefer to maximize your returns, or you will prefer to minimize your risk. So this is one model which helps us in understanding that as an investor, what should be your required return? What should be your expected return if you are bearing a little extra risk? Now, there are two types of risks when we talk from the perspective of investment. So the total risk is a combination of non-diversifiable risk, which is related to a specific security, and the second category of risk is your diversifiable risk, which is applicable to all the securities in the system. So when we talk about diversifiable risk, it is the portion of an asset's risk that is attributable to firm-specific, random causes, and can be eliminated through diversification, and therefore it is also known as unsystematic risk. Now this is one risk which can be diversified, whereas the other risk, which is non-diversifiable, systematic risk. So this non-diversifiable risk is the relevant portion of an asset's risk attributable to the market factors, not firm specific but to the market factors that actually affect all the firms in the market, and therefore it cannot be eliminated through diversification. That means a risk which is applicable to all the securities in the system. Because any investor can create a portfolio of assets that will eliminate virtually all diversifiable risk. the only relevant risk is non-diversifiable risk. That means when you put your funds in, say, 10 different stocks, you are kind of eliminating, you are kind of removing your diversifiable risk, firm-specific risk, business-specific risk. But when you create this portfolio, you certainly cannot avoid non-diversifiable risk or systematic risk. Now, when we continue increasing our investments, have a look at this figure. When we are investing in, say, stock 1, and when we increase our investment from stock 1 to 2 to 3 and then 5 to 10 to 15 to 20 and then to 30, you can see as we continue investing our risk, our total risk starts falling. On the x-axis, we have the number of stocks, and on the y-axis, we have the quantum of risk. So, if we see whether we invest in 10 stocks or we invest in 20 or we invest in 30 stocks, the lower portion, there is a minimum risk which is known as a non-diversifiable risk, which always exists. That means even if we put our funds in one stock or we put in 100 stocks or infinite stocks, the non-diversifiable risk is certain. It is pertinent, it is always applicable. However, as we discussed, that if we increase the number of stocks from, say, 1 to 5 to 10 to 20, the overall total risk continues to fall. That means the risk which can be diversified continues to fall, because of which the total risk also falls. As we know that total risk is a combination of your systematic, which is non-diversifiable, and unsystematic, which is diversifiable risk. So, as we increase our number of stocks in the portfolio, we are actually diversifying by investing in different industries. We are trying to diversify and eliminate the risk which is related to a particular business. So, in this way, when we continue to increase our number of stocks in the portfolio, the total risk continues to fall, which is a summation of diversifiable and non-diversifiable risk. Now, capital asset pricing model, it is the equilibrium model that underlies all the modern financial theories as on date. Because this is one model which helps us in understanding that as an investor, what is the return which you should expect by taking extra risk, because you know that there is certain amount of risk-free rate of return which is always available. That means if you put your funds in your FDs, you know it is certain that you're going to get your money back. You know that you're going to get 5%, 6% return on it, whether you put it in your treasury bill or you put it in government securities. So all these things are considered to be free of risk. So, as an investor, you would always want at least that much return. Now, when you are getting the basic return, say 6% from bank FD or 6% from a treasury bill or a government security. So, this return is fixed. But when you take a decision to buy not investing in government securities, which is absolutely safe, but you prefer investing in a stock which is relatively riskier than the government security. Now, as an investor, you would always say that why should I get just 6% then? Because the quantum of risk is increasing now, my return should also increase. So, this model says that as an investor, your expected return or your required rate of return is actually a summation of two components. The first component is your risk-free rate of return, which is your 6% in the example which I just cited, plus the return because you are bearing the risk, additional risk. How do you calculate this extra return? This is market return minus risk-free rate of return multiplied by the beta of the security. But there are certain assumptions which are related to the capital asset pricing model. So let us look at these assumptions. The first is that investors are risk averse. That means if you are an investor, you would always prefer to avoid risk. You will never say, okay, I am ready to take a lot of risk. So you will always as an investor prefer to be safe and get more return. So as an investor, your objective would be risk minimization. The second assumption of capital asset pricing model is that investors, they can borrow and they can lend freely at a risk-free rate of return. Now, this is one assumption which has actually got a lot of criticism, because the rate of return will certainly vary. The interest rate on which you are borrowing or at which you are lending will certainly vary depending on your creditworthiness or the creditworthiness of the person to whom you are lending. But capital asset pricing model is based on the assumption that investors, they can borrow and they can lend completely freely at a risk-free rate of return. So the rate of interest is same irrespective of the CIBIL score, irrespective of the credit worthiness. The third assumption of CAPM is that single period investment horizon is there. So if you are comparing two stocks, if you are comparing two investment alternatives, for both there is just single period investment horizon. So if it's 1 year for here, 1 year for the other investment as well. Next assumption is that investments are limited to traded financial assets. So something which cannot be traded will not be coming under the category of CAPM. It also assumes that there are no taxes, there are no transaction costs in the market. However, we understand that when we invest in stock market, there are transaction costs, there is brokerage, there is commission which we need to pay. So it assumes that there are no taxes and transaction costs. So whatever return you're getting from the asset is completely yours and there are no taxes over it, which is again one assumption which is not practical. Because as an investor, when you prefer investing in, say, for example, you prefer investing in PPF. You know that when you're putting your funds in public provident fund, the funds when you're investing, you're getting tax rebate. The return which you're getting is again exempt from tax, and the final money which you're getting at the maturity time after 15 years is again exempt from tax. So as an investor, you will certainly see that how much tax exemption or tax shelter am I getting when I am putting my funds in a particular asset. However, CAPM says the assumption is that there are no taxes and then there are no transaction costs. Another assumption is that information is costless and available to all the investors. However, this is again one such assumption which is not very relevant to the stock market, because we understand that there is a lot of insider trading which takes place, and a lot of people have access to such information which is not readily available to all the investors, and that is why we say that the Indian stock market specifically is in the semi-strong phase of EMH, that is efficient market hypothesis. It is not in the strong form of efficient market hypothesis. Another assumption is that investors are rational. So they are logical and they are rational mean variance optimizers. That means they will always optimize the mean and variance. That means they will always want higher return given a certain level of risk, or they would expect minimum risk given a certain level of return. Then the expectations are homogeneous. That means all the investors expect the same return, and there are homogeneous expectations. They all understand that the market is going to move in the same direction and there is no difference in the mindset. So these are all the assumptions on which CAPM model was built, and it was introduced by Trenner Sharp, Lintier and Mawson independently, building on the earlier work of Harry Markowitz on diversification and modern portfolio theory. So it is actually, this model is known specifically by Trenner Sharp. So Sharp, Markowitz and Merton Miller, they jointly received the 1990 Nobel Memorial Prize in Economics for this contribution to the field of financial economics. Because this is one such model on the basis of which the entire, I would say, financial economics as well as finance, the investment, security analysis is completely dependent. So it's a very, very important model. And this model, as you can see on the screen, clearly states that the expected return of an investor is a combination of two components. The first one being RF, which is the risk-free rate of return. The example which I just cited here, we're talking about, say, the return on treasury bills, the return on government securities. The second part of CAPM is that expected return can be calculated after considering risk-free rate of return. It is the market risk premium. That means the additional risk which is applicable to the particular stock multiplied by the difference between market return and the risk-free rate of return. So when you are shifting from your FDs or your government securities to stock market, the return has to be higher. That means the expected return from the market portfolio. So the return from Sensex, say for example, it is 15%, minus the risk-free rate of return, say, which is 6%. So 15 minus 6, that is 9, multiplied by the beta of the security. So if the beta is higher than 1, obviously market risk premium will be high and the expectation from the investor's perspective would be higher. Now, what exactly is beta here? Beta is one of the most important concepts that you need to understand while trying to learn about stocks and investments. Why? Because beta is an important indicator of how susceptible a stock is to movements of the market. Therefore, beta, it indicates the sensitivity of a stock to movements in the overall market. So we need to understand how do we interpret the beta. So if suppose there is a stock with beta 1, that means this stock is actually representing the market. Why? Because the risk associated with this specific stock is actually that of the market. Therefore, a stock with beta 1 will always move with the market. Market goes up by 10%, this stock goes up by 10%. Market falls, this stock falls in the same quantum. Now, if there is a stock with a beta say greater than 1, now this stock is highly aggressive. If the market increases, this stock is going to increase more than the market. If the market falls, the stock is going to fall more than the market. So this kind of a stock with the beta greater than 1 is considered to be a highly aggressive stock. Now when we look at penny stocks, they are those stocks with small cap. When you invest in small caps or penny stocks, they are very, very risky. So that is why their betas are always higher. And as an investor, your expected return also increases because you are taking additional risk. You always prefer to have additional return as well. But if you're selecting a stock with the beta which is say less than 1, this means that the stock has less risk vis-a-vis the market, and in that case the market falls, the stock is not going to fall in the same quantum as the particular market is falling. So that is how we interpret beta. So when we calculate the expected return as per the CAPM, we divided it into two. The first one is your risk-free rate of return, which is the required return on a risk-free asset. Typically a 3-month treasury bill, or it can be 3-month government securities, or maybe an FD in say post office. And the second portion is your risk premium. So the risk premium, which is calculated by the market return minus the risk-free rate of return, this portion of the risk premium is called the market risk premium. Why? Because it represents the premium the investor must receive for taking the average amount of risk associated with holding the market portfolio of assets. So because you are bearing additional risk, you are entitled to get additional return. So as per CAPM, we have two components. The first is risk-free rate of return and the second is the risk premium. Now let us try to understand or solve one problem. As you can see here, the question says if the risk-free rate equals to 4% and there is a stock with the beta of 0.75 which has an expected return of 10%, so what is the expected return on the market portfolio? Now this is a question which is saying you have risk-free rate of return, you have the beta, and you also know that you are expecting a return of 10%. The expected return is 10%. But if we have this sort of a scenario, how do we calculate the expected return on the market portfolio? So here, if we put these figures, here we can see that when we are going to calculate, the expected return is already given to us. So we start with putting 10% is equal to the first component, risk-free rate of return. So in this case, the risk-free rate of return is 4% plus the beta. The beta is 0.75. We are supposed to calculate the value of market portfolio. So we have written market portfolio minus the risk-free rate of return, which is 4%. So when we calculate this, it comes out that the market portfolio return is 12%. So the question can be this way, there can be a direct question as well, wherein your market portfolio return is given to you and you are requested to calculate the expected return from that particular stock. This is one example where we can use capital asset pricing model. Let us look at another practice problem. There is a particular asset which has a beta of 1.2 and the expected return of 10%. Now, given that the expected return on the market portfolio is 13% and your risk-free rate is 5%, you are required to calculate whether the stock is appropriately priced or whether it is underpriced or whether it is overpriced. So, how do we do that? We try finding out that what is the expected return with the help of CAPM. So, the CAPM says that your expected return first component, that is your risk-free rate of return. Now, in this question, your risk-free rate of return is 5% plus the beta. Now, in this case, the beta is 1.2. That means the stock is relatively aggressive, it is relatively risky, multiplied by the market risk premium. How do you calculate the market risk premium? That is market return, which is 13, minus the risk-free rate of return, which is 5. So, when we do this calculation, our calculation expected return, which is the bare minimum required return by the investor, is 14.6%. But the stock is actually giving you 10%. So, as an investor, your expectation is 14.6% because you know that as per the capital asset pricing model, your return needs to be 14.6%, but this stock is just stating that the expected return is 10%. So, for you, this stock is overpriced. You will prefer not to invest in this stock, or if you are already holding this stock, you will prefer divesting your money into it, or you'll prefer selling it out. So, this is how CAPM can actually be used to identify whether a stock is appropriately priced or whether it is underpriced or it is overpriced. The third question. Let's say last year there was firm A whose return was 10% and its beta was 0.8. The second firm has a return of 11% and beta is 1. And the third firm has return of 12% with the beta 1.2. So, we have a combination of 3 firms in our portfolio. Now, given that the risk-free rate was 3% and the market return was 11%, which firm has the best performance? That means, which is the firm which is actually giving the best return? So, let us calculate. Now, here firm A we calculate using CAPM, wherein we first put the value of risk-free rate of return, which is 3%, plus the value of beta, which is 0.8, then market return 11%, risk-free is 3%. So, when we calculate, this comes out to be 9.4%. But what are we getting? Expected return is 10%. Here it is 9.4%. That means firm A is it is performing the best because it is exceeding the expected return. The expected return was 10 and here we are getting 9.4. And for firm B, again RF is 3%. We put beta 1, we find the difference between expected market return and the risk-free rate of return, which is 8. So, when we do the calculation, it comes out to be 11%. And we know that the required return was also 11% here and the actual return is also 11%. So, as an investor, you will be neutral. What you expected, you are getting it. So, it is neither overpriced nor underpriced. It is exactly the same. Firm C, when we do the calculation again using CAPM, we find 3% risk-free rate of return. Now, here this firm is actually having a beta which is 1.2, which is very, very risky. Now, here when we calculate, we find out that as per CAPM, our required rate of return is 12.6%. However, the actual return is 12%. So, as an investor, you will prefer not to invest in firm C. It is an underperformer. So, when we want to calculate the overperformer or underperformer, we will prefer amongst firm A, firm B and firm C, we will prefer firm A because it is performing the best. Why? Because it is exceeding the expected return. Firm A's expected return was 9.4%, whereas the actual return is 10%. Now, with this example, we have understood what exactly is capital asset pricing model. Now, this capital asset pricing model is based on the security market line. This is the depiction of the capital asset pricing model as a graph that reflects the required return in the marketplace for each level of non-diversifiable risk, that is, for each level of beta. It actually reflects the required return in the marketplace for each level of non-diversifiable risk. As we can see here on the graph, risk is measured by beta B and it is plotted on the x-axis, and the required return is plotted on the y-axis. So we can see clearly that any stock which is on this security market line is perfectly alright, is performing well. Any stock above it will be an overperformer and any stock under it will be underperformer. So with this, we have understood the concept of capital asset pricing model. We've understood what is security market line. How can we do as an investor make a comparison that which stock is best performer? We've had an idea of what exactly systematic risk is, what beta is, and we are better informed about our investments. Thank you so much. Wishing you happy learning.